There is a number sitting on Micron's stock page right now that most investors scroll past without fully understanding what it means or why it matters. The quant rating score. And if you knew what was inside that number, the five specific factors it measures, how it compares each one against every other company in the sector simultaneously, how it updates every single morning before the market opens, you would probably pay more attention to it than you do to most of the price targets and analyst recommendations that dominate the financial media. Here is the headline that should get your attention before we get into the mechanics. Over the past 5 years, stocks rated strong by a rules-based quantitative system of the kind we are going to break down today have returned approximately 170%. Over the same period, stocks rated strong by Wall Street analysts have returned approximately 12%. And the S&P 500 over the same window is up roughly 52%. That is not a small difference. That is a systematic, measurable, multi-year gap between what professional human analysts recommend and what data-driven quantitative models identify, and understanding why that gap exists is the most useful thing you can take away from this video. Quick disclaimer before we go any further, nothing in this video is financial, investment, or tax advice. I am not a financial advisor. This is purely educational. Please always do your own research and consult a qualified professional before making any investment decisions. Let's start from the foundation. What is a quant rating system and what is it actually measuring? A quantitative rating system, or quant system, uses mathematical models and financial data to evaluate stocks against a defined set of criteria and produce a directional recommendation. The word quantitative makes it sound complex, but at its core, a well-designed quant system is doing something fundamentally simple. It is applying fundamental investment analysis, the same kind of analysis a Goldman Sachs or Morgan Stanley analyst performs, except it is doing it at the speed of a computer across thousands of companies simultaneously and refreshing that analysis every single day. A human analyst covering a sector can realistically track 15 to 20 stocks in depth. They know their companies well, they have relationships with management, they understand the competitive dynamics intimately. But their coverage is narrow by necessity. A well-built quant system can cover every publicly traded company in a sector simultaneously, applying the same analytical framework to all of them on the same day, updating every metric the moment new data arrives. The analysis is not better in the qualitative storytelling sense. A quant system cannot tell you why a CEO's strategic vision is compelling or why a new product launch might exceed expectations. But in the systematic, comparative, data-driven sense, it is faster, more consistent, and more comprehensive than any human analyst can be. The specific framework being applied matters enormously. A quant system that focuses only on price momentum will perform brilliantly in trending markets and collapse when momentum reverses. A system that focuses only on cheap valuations will find deeply discounted companies, many of which are cheap for very good reasons. The quant systems that have the strongest long-term track records tend to be the ones that look across multiple independent factors, simultaneously factors that are not necessarily correlated with each other, and require a stock to score well across all of them before issuing a positive recommendation. The framework we are examining today uses 5 core investment characteristics: value, growth, profitability, EPS revisions, which means analyst earnings estimate revisions, and momentum. Each of these 5 factors has multiple underlying metrics feeding into it, and each metric is evaluated not in absolute terms but relative to every other company in the same sector. Let's go through each factor, because understanding what they actually measure changes how you interpret the scores. Value captures how expensive a stock is relative to its fundamental measures of worth. Under this factor, you will find metrics like price-to-earnings ratio, price-to-book, EV/EBITDA, price-to-sales, and a range of other valuation multiples. The critical distinction from how most investors use these numbers is that a quant system does not evaluate them in isolation. It compares them to the sector average. A PE ratio of 25 might look expensive in isolation, but if every other company in the semiconductor sector trades at a PE of 40, then 25 is actually cheap relative to where the money is flowing in that market. Sector relative valuation is a far more actionable signal than absolute valuation, and it is one of the things a systematic quant approach does better than most individual investors who anchor to absolute numbers. Growth captures the trajectory of the business across revenue, earnings per share, EBITDA, EBIT, and return on equity. Again, the comparison is sector relative. A company growing revenue at 30% might sound impressive until you learn that every other company in its sector is also growing at 30% or faster, at which point the growth premium disappears. Conversely, a company growing at 20% in a sector where the average is 5% is generating genuinely differentiated growth that deserves a meaningful premium in the rating. Profitability captures the quality of the business margins, return on assets, return on equity, free cash flow generation. This factor helps screen out companies that are growing fast but burning capital to do it versus companies that are growing efficiently with strong underlying unit economics. Profitability is often what separates companies that sustain outperformance for years from companies that look exciting for a quarter or two and then disappoint. EPS revisions is arguably the most differentiated factor in a well-built quant system and the one that is hardest for individual investors to replicate manually. This factor measures what Wall Street analysts are doing with their earnings estimates, specifically whether they are revising their forecasts up or down, by how much, and how many analysts are making similar revisions simultaneously. The power of this factor comes from an insight about how analyst behavior works in practice. An individual analyst revising their Micron earnings estimate from $4 to $4.05 is making a change so small that no publication will cover it and no investor will notice. But when 20 or 30 or 44 analysts simultaneously revise their Micron estimates upward by small amounts, and 0 analysts are revising downward, that collective signal is extraordinarily meaningful. It means the consensus view of the people who track the company most closely is becoming more optimistic across the board, even if no individual revision is dramatic enough to generate headlines. A quant system picks up that aggregate signal daily. A human investor trying to track it manually has no realistic way to do so. Momentum captures the stock's price performance over multiple time periods. Most professional analysts do not look at momentum, they focus exclusively on fundamental analysis and often view momentum following as superficial or speculative. But the empirical evidence for momentum as a factor is robust across decades of academic research. Stocks that have been outperforming their peers over recent periods tend to continue outperforming over the following months more often than random chance would predict. Including momentum alongside fundamental factors creates a more complete picture of which stocks the market is currently rewarding. The key philosophical point about using all 5 factors simultaneously is this: they are deliberately not correlated with each other. Growth stocks are often expensive, meaning a strong growth score frequently comes with a weak value score. Value stocks often have poor momentum because they have been falling in price to get cheap in the first place. Profitability and momentum can diverge sharply during sector rotations. By requiring a stock to score well across all 5 factors simultaneously, the system is filtering for genuinely rare combination companies that are cheap relative to their sector, growing faster than their peers, generating strong profits, being revised upward by analysts, and exhibiting positive price momentum all at the same time. That combination, when it exists, has historically been a very powerful predictor of future outperformance. Now let's put this framework to work on a specific example that illustrates how the system plays out in real time: Micron technology. Micron's current quant rating sits at 4.99 out of a maximum that approaches but never actually reaches 5. Understanding why a perfect score is 4.99 rather than 5 requires knowing that underneath the letter grades is a z-score system, a statistical measurement of how many standard deviations away from average a company sits on each metric. The 4.99 reflects a near-perfect z-score composite, and the academic letter grades A+, A, B, C, D, F are a translation of those z-scores into a format that gives you an instant intuitive read on where a company stands. A B+ on valuation means Micron is significantly cheaper than its semiconductor sector peers, even after its extraordinary price appreciation. An A+ on growth means Micron's revenue and earnings growth rates are dramatically above the sector average. An A+ on profitability means the business is generating returns on capital that outperform nearly every peer. An A+ on momentum means the market has been consistently rewarding Micron shareholders over recent periods. A B on EPS revisions means analyst estimate revisions have been broadly positive, though not quite as unanimously bullish as some of the other grades. What makes Micron's quant history particularly instructive is seeing how those grades have changed over time and how those changes corresponded to the stock's performance. Going back to mid-2023, Micron carried a hold rating because despite everything that seemed potentially interesting about the memory sector, the valuation grade at that time was an F, meaning Micron was genuinely expensive relative to semiconductor sector peers on the available fundamental metrics. The quant system was correctly identifying that the stock was priced for a future that had not yet materialized, and it held off on a buy recommendation until the data supported one. Then the data started changing. As Micron's A-related revenue began accelerating and analyst estimates started moving decisively upward across the board, the valuation grade improved from F to C- on the date the rating flipped from hold to buy. That might seem like a modest improvement going from F to C- is not exactly a ringing endorsement of cheapness, but the combination of an improving valuation trend alongside dramatically upgrading growth and EPS revision grades was enough for the composite to cross the threshold into strong buy territory. And crucially, the price at that transition point was still in the range of $100 to $111 per share. The stock has since reached over $1,000. The most counterintuitive insight from Micron's quant history is what happened to the valuation grade as the stock rose dramatically. Most investors assume that a stock which has risen 300% or 600% must have become expensive. The quant system shows something different. As of today, Micron's valuation grade is a B+, meaningfully better than the C- grade it had when the strong buy rating was first issued. How is that possible? Because Micron's earnings and revenue have grown even faster than its stock price. The PE ratio of approximately 18 times versus a semiconductor sector average of approximately 24 times means that despite the stock being up enormously, it is actually cheaper relative to its fundamental value today than it was when it was at $111. The growth rate of approximately 94% forward revenue versus the sector average of 11% means the premium you are theoretically paying for future earnings is actually justified by an extraordinary growth differential. This is exactly the kind of insight that reverses the intuitive but incorrect conclusion that an expensive price means an expensive stock. The price target debate that emerges from all of this is worth addressing directly because it speaks to a fundamental disagreement between how most retail investors think about stock ownership and what the data suggests is actually more productive. Most investors set price targets. They buy a stock at $600 with a target of $1,000 and plan to sell when it gets there. The logic seems reasonable. You have identified an investment, you have a thesis, you have a destination price, and when the price arrives, you take your profit and move on. The problem with this approach is that a price target assumes the fundamental picture of the business will be roughly the same when the stock hits that price as it was when you set the target. That assumption is almost never true. When Micron hit $1,000, the company's growth rate was higher than when the $1,000 target was set. The valuation relative to sector peers was more attractive. The analyst consensus was more bullish. Every fundamental signal was stronger than it had been when $1,000 was chosen as the exit price. Selling at $1,000 because a number was written on a spreadsheet 6 months earlier is letting an arbitrary reference point override the actual data about the company's trajectory. The alternative framework evaluating whether to hold, add, or trim based on the current fundamental picture, rather than a predetermined price, requires more discipline but produces better outcomes over time. The question to ask is not whether the stock has reached some price target, but whether the underlying grades on value, growth, profitability, EPS revisions, and momentum are still supportive of ownership. If Micron's forward revenue growth rate were to drop from 94% to 8% and the valuation grade deteriorated from B+ to D, those would be the signals to reconsider the position. A stock price hitting a round number that was written on a spreadsheet is not. The practical implication for investors who experience market pullbacks in strong buy positions is also worth understanding through the lens of the quant framework. When Micron pulled back from its peak toward $900, the kind of move that sends investors to social media posting about whether to sell, the question to ask is whether the fundamentals changed. If the EPS revision grade is still improving, if the growth grade is still an A+, if the valuation grade is holding its B+ even at $900, then the pullback is price volatility without fundamental deterioration. Those are typically the optimal opportunities to add to a position rather than reduce it. The quant system flags exactly this when a stock you own is still rated strong buy on all 5 factors and has come down in price. The math of the valuation grade has just improved further, which means the case for ownership has strengthened rather than weakened. For investors trying to use this kind of systematic framework in their own decision-making, the most important behavioral shift is to stop anchoring on price and start anchoring on factor grades. The question is not whether the stock was at $306 months ago and is at $1,000 today and therefore must be overextended. The question is whether the company's value, growth, profitability, EPS revision, and momentum grades are currently supportive of ownership relative to its sector peers. If they are, the historical evidence suggests holding or adding during pullbacks outperforms selling based on price levels that were determined by intuition or arbitrary benchmarks. The daily update cycle matters for this practical use as well. The quant scores refresh every morning between approximately 4 am and 6 am, incorporating any analyst estimate revisions, price changes, new earnings data, or momentum shifts from the prior day. This means that on any given morning after a significant market event and earnings report, a major macro announcement, a geopolitical development, the factor grades for your holdings will reflect the updated data before the market opens. A stock that is a strong buy today could be a hold tomorrow if analysts simultaneously revise estimates down in response to negative news. The system catches those changes faster than any other approach available to retail investors and translates them immediately into the five-factor grade framework that makes the change interpretable without requiring you to dig through financial statements yourself. The existence of three separate rating systems on a platform, the quant rating, a community analyst consensus, and the Wall Street analyst consensus, is designed to provide independent validation or useful tension rather than confusion. When all three are aligned on a strong buy, you have convergent evidence from a data-driven system, a community of independent researchers, and the professional analyst consensus. When they diverge, as with Micron, where the quant system carried a strong buy while the community consensus was a hold, the divergence is itself informative. It tells you to go read what the hold arguments are, understand them specifically, and then decide whether the fundamental data you are looking at overrides the concern being raised. The quant system, having the strongest 5-year performance track record among the three approaches, suggests it should carry the most weight, but treating it as one input in a broader assessment rather than the only input is intellectually honest about the limitations of any single analytical framework. What a quant system cannot do is also worth being clear about. It cannot tell you the story of a company, the qualitative dimensions of management quality, competitive moat depth, or strategic positioning that require human judgment and industry knowledge to evaluate. It does not predict specific catalysts like product launches, regulatory decisions, or merger announcements. It does not know that a specific CEO has built a company culture that produces sustained innovation over decades. For those insights, human research, reading earnings transcripts, following industry experts, talking to customers and competitors, provides information that no quantitative system can replicate. What a quant system does extraordinarily well is process large volumes of fundamental data consistently, compare it systematically across the full sector universe, update it continuously as new information arrives, and translate it into interpretable signals without the emotional biases that make individual human investors systematically buy high and sell low. The combination of quantitative systems for the data-driven signals and qualitative research for the story behind the numbers is more powerful than either approach alone, and the five-factor framework we have walked through today provides a structured, historically validated foundation for the quantitative side of that combination. At Dividend Desk, whether we are covering income ETFs, growth stocks, or the analytical tools that help investors make better decisions, the commitment is the same: honest, complete analysis without the promotional noise. If the quant framework resonates with how you want to think about your portfolio, dig into the methodology, backtest it against your own holdings, and see whether it changes how you interpret the price action in the stocks you own. The evidence suggests it is worth taking seriously. If this breakdown was useful, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community link in the description, where we go deeper on investing frameworks, income strategies, and market analysis every week. This is Dividend Desk. We will see you in the next one. This video is for educational and informational purposes only. It does not constitute financial, investment, or tax advice. Dividend Desk is not a financial advisor. Always do your own research and consult a qualified professional before making any investment decisions.